Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 305, and India seems to be right on top in terms of its positioning in the global markets. We will show you how it has diverged from rest of the markets, even when markets within the MSCI framework have been falling and other emerging markets have been falling. We have gained from strength to strength. So there is something special about India that's going on. It is happening in front of us, in front of our eyes, and we should realize that this is a sort of a golden moment that is happening for our markets and make use of that. But first let's take a look at the markets today. So markets were very, very flat today, rather I would say totally listless and dull, except that there were some profit booking and sell-offs in FMCG space. PSU banks that have run up 26-29% in the last month or 3 months gave up some ground, very little bit. But what was very heartening to see is that real estate picked up 1.1%. and metals have picked up 1.7% today. Metals that have been battered in the last month or so have come back, and now for the last 1 month and 3 months the metals looking quite good. So it seems that the market is taking the indication that the dollar has peaked and that the risk on trade will start again. China opening up is also seen to be a good possibility going forward, and all that helps the metal sectors in a big way. Also, today's inflation figures for India have been better than expectations, giving hope that maybe the interest rate hike cycle that we have seen in the past many months is coming to some maturity, and real estate can benefit from that. Very important to note that despite the interest rate hikes that have been happening, there has been virtually no stopping the real estate bulls. If you see the new launches, if you see the market sales of large companies, they have not really stopped because of higher mortgage rates. Auto loans, you can see that there's a queue for buying automobiles. There's a 3 month, 6 month, 2 month waiting on practically every car that you can see. Of course, two-wheelers are not in the same boat right now, but they can pick up pretty fast. Another sort of sector that we need to keep watching is the pharma space. While today there was no change, but many pharma stocks, especially the mid and small ones, have been cracking pretty hard. So we've seen really bad cracks in Divi's Lab or Window Pharma, today Copran. Many other pharma stocks have not done so well, whereas some large caps like Sun Pharma, etc. are doing extremely well. Abbott Industries, another one. So there are these specific pockets which are playing differently within the same sector. Overall, there was nothing much in the market today, as I said, quite listless, but small caps and Nifty Next 50 still managed near about 0.5% gain. Mid and small cap index totally flat, CNX 500 totally flat, 200 flat, and Nifty giving up very slightly. In terms of weekend investing, small case performances, MI35 did really well, 1.58% up. MI-NNF 10 also did all right, 0.42% up. Small cap MI25 did all right. So many strategies in the 0 to plus 0.5% bracket, but some of them losing ground. MI India top 10 especially, along with MI MT all cap. So overall, a sort of a dull day so far. And you can see why, because several of these large names are there in our strategies. ITC is down 2.57% today. Hind Lever is down almost 2%, Nestle is down 1.2%, Coal India was down 2.4%. Then you had falls in Power Grid, Bharti, L&T, Mahindra, Titan, Wipro, HDFC Life, ICICI Bank and State Bank also falling 1.5%. The only few green spots were Tata Motors at plus 2.4%, Grasim at plus 2.3%, and some other minor ones. But other than that, market was dull, listless, and just of no interest right now. Top gainers in the CNX 500 universe: Krishna Institute or Institutional, I don't know what is the full form here, is gained plus 9%. Fortis Healthcare up 7.5%. Raymond has been doing very well, plus 7.2%. Mannapuram Finance, even despite the results were not looking optically so good, plus 7.2%. So I always say results are a snapshot of the past and they tell you nothing about the future pretty much. So this extrapolation of results, good results also and bad results also, need not always work. Rail Vikas up another 6.5%. Rail Vikas has been doing extremely well, winning big orders. Sun TV Network down 9%. DCM Shriram, bad results, I think 8.5%. Restaurant Brand down 7.1%. New India Assurance down 6%, and Go Fashion also down nearly 6%. So this is a chart of source from Bloomberg MSCI, where it is showing the white line as the normalized India index, MSCI India index, and you can see that from 2012 India has gone from 0 to 200 on this index, 200% gain, so it has tripled in the last 10 years. And tripling in last 10 years is an extremely good growth rate. The blue line is the MSCI Emerging Market Index, and you can see it has gone nowhere. From 2012, the blue line is still where it was, and the pink line is the MSCI China Index, again 10 years, and it has gone nowhere. So just see, while there was some camaraderie between the three up till 2020 post-COVID, but after this 21 started, India has gone up, whereas MSCI China has retraced all gains that it had since, let's say, 2015. MSCI Emerging Market Index has come back to the same point at where it was in 2012. This is very, very stark. So it is telling us that India is definitely on a very, very strong wicket. The charts will tell you a story which, it is difficult to weave otherwise, looking at, things around you. I mean, there is all kinds of issues playing out in every country, and the markets are actually the most efficient way of tracking where things are going. So market will tell you first before even you realize, whether the economy is doing well or it is not doing so well. So right now we are poised very, very nicely. We can still go higher. There is no reason to think that we'll just go, down from here. But the trend that we have, diverged from emerging market MSCI index as well as MSCI China is very, very stark since 2021, and I hope that this will continue and we can make this a decade of Indian growth in years to come. Another insight that I shared on Twitter today was that a chart can tell you a story if you look at it and think of it as a tool that can relay a simple story to you. So if we see this Bitcoin chart, for instance, and I can say that while it is easier to get these buy and sell points in hindsight, but even otherwise, if you are principally following simple strategies, you will see this when it happens. So you can see that a higher high was made in this July to October period above the previous highs, and you were making higher highs. somewhere around this 12,000 mark, 11,000, 12,000 mark, and you can see that it just went up. It came down here, made a higher low, went up, made a higher low, went up, and made still a higher low, but a lower high here, and then crashed down. So this was the point where actually, and this is a weekly chart, you could do this on daily or monthly as well, where really after 12,000, around 47,000 is where a real exit in Bitcoin was to be made as per this chart. You should not have done anything during this period, and you could have short sold here at 47, and it was going lower lows, lower highs, and then it made a higher high here. So you could have gotten out here somewhere around 43,000, 42,000, gone long. And again it made a higher high, higher low, higher high, higher low. And then when it crashed here, a tighter situation would have come here, but I think mostly it would have come here near 40,000. So you may not have made any money on this trade. And then if you sold at 40,000, and bought again at 45,000 here, that would have been a whiplash trade, but you still would have gotten out at the lower low here at 32,000. So you may not have made any money in this entire period, but it would have saved you from holding this in the last 50% drop at least, and here it would have made you tons of money in this leg, some money in this leg. So having a strategy, having some plan is always beneficial, and although this is a very simplistic way of looking at the chart, you can add some more indicator. You can maybe add a trend line, you can maybe add a moving average, and create a rule based system that if this happens I will do this, if this happens I will do that. At least there is no ambiguity in terms of I bought at 64,000 and now it is 16,000, what should I do? At least you will not be in that boat, and if you are in that boat, believe me, your capital is already eroded by 70-80%, and getting back to your original capital is 5x from here, and only God can give you that gift if you want it very, very quickly to get back to 100 from a position of 20. So the idea is to perceive, or to at least keep yourself open to what the charts are telling you, what simple strategies can do for you, and so on and so forth. Another very nice market insight was there on Twitter. This was by Elliott Wave International. The author said that everybody is looking for the Fed pivot. What this means is that everybody is looking at the point where the Fed will say, okay, we are not hiking and we've stopped hiking and now we are having to go to QE again. So that's like pivoting from money tightening to money easing. Now all participants are waiting for that to happen and anticipating that the market will go up like a rocket from that point onwards. However, if you go back and see the last 50 years of data, and as the saying goes, that facts should be believed more over fiction. So what you can see in this data is that after each pivot, so let's see this. So in this is 1969 or 1970, interest rates peaked here and interest rates started to drop and the market crashed 30-40%. Here again in mid 70s there were two periods where interest rates started to drop, market crashed 48%. Here again, interest rates peaked out at 17-18% after that Paul Walker tightening and market crashed 27%. We did not have, post this fall, there was no commensurate fall after this, it was a rise. Again, after the fall in early 2000, the interest rate cut cycle, post that there was a crash here. Again 2008, post the, actually these two I would say would be in sync. It was not that post interest rate cut, the market fell. The market was falling while the interest rate was also getting cut. And here also, the Fed pivot happened, or at least the hiking had stopped while the market crashed in the COVID area. So what this is telling is that once the interest rates stop going up, that need not be the market bottom. That may still be the phase where the market is coming down, and it is only after some time that the market will bottom and start to go up. So there will be a lag effect whenever the Fed pivots. So don't be in a rush, and this may or may not be applicable immediately to India market because we are anyway sitting at all-time high. But for global markets, for cues to come from global markets, there could be a lag between when the Fed says that we are stopping to hike and the market taking off, because there may be a percolation of that impact into the markets over a period of time, and the animal spirits may not start from day one itself. So this is some insight that one needs to be aware of. Whether this will play out or not this way the next time is anybody's guess, but a good sort of data to keep in mind to try to predict market moves for those who do that. We don't do that, so we really don't care much about all this data, but these insights are for everybody who's out there, not necessarily only momentum investors into this. This is the disclaimer from our company, and thank you so much for your time. Please do share these videos with your friends and family. If you like these videos, please do give us a like, and if you've not subscribed so far, please subscribe to these videos, and do keep sending us your feedback. We really like to receive feedback, whether good or bad. It helps us improve. It helps us keep doing this on a daily basis, and I'll see you in another video. Bye.